Hello again, and thanks for tuning in this week. So, you know that I'm regularly complaining or going on about economists, especially the ones that are working for banks, paid employees. They work for real estate brokerages and whatnot. Well, I finally saw a report, a quick clip. I'm going to put it here in the link, and I'm going to try to put it on the page that you can click on it. But this is from a Charles St. Arnaud, chief economist with Alberta Central. I think it's a central Bankers Association for Credit Unions in Alberta. He used to work for the Canadian or the Bank of Canada. It's a 6.5 minute clip. I'm not going to play it now, but it is entitled, What Does It Mean to Restore Housing Affordability? And of course, I've said this before, but there's two ways to restore housing affordability, in my opinion. And he kind of backs this up in this short interview, and it is by house prices going down or wages increasing. And of course, wages would have to increase by almost double in Canada to restore housing affordability, and that would take a long time and that would add to inflation. So, of course, I think the more reasonable way or the more historical way that prices and affordability gets adjusted is by prices going down. So I encourage you to watch this short video from BNN Bloomberg. It really sums up this topic very efficiently and in plain terms. I'm just going to share one screenshot from it while I'm on this topic, and this was how much would prices need to drop at current levels of income and interest rates in Canada in these major cities for to restore housing affordability. Of course, Toronto, you'd have to see a 50% drop in house prices. Vancouver, 38% drop. I thought that would be more than Toronto, but anyway. Montreal, you need to see a 43% drop, and Ottawa, a 35% drop in house prices. So it kind of really adds some decent perspective to the situation we're in right now. I do have some statistics from the places I missed last week, like Montreal, Quebec, Ottawa, and things like that. So I'm going to get into those at the end. But first, I want to go through a few charts and explain them. I posted them on Twitter or X this week, but I kind of want to go through them in detail or in, more thoroughly than however many characters they give you on X to explain something. First one here, this is from the Toronto Real Estate Board. I've shown this on here before. This is from January 1986 to 1992, kind of through that peak boom and bust cycle, whatever you want to call it. I don't have Canadian data, or else I would like to use that. So I have to use what I can use from a major area in Canada. House prices, decline in house prices correspond with cuts. A lot of people think I'm saying it's because of cuts. It's not because of cuts. It's because of the lag time. Interest rates need so much time to do their work. And of course, by the time they start cutting, that lag time catches up. And of course, the economy and the homeowners are in dire situations. So here is, again, the Toronto Real Estate Board. You can see they started to cut and prices declined along with the cuts. They actually started declining before the cuts in this case because interest rates had done their job. Next, I want to move on to the US in 2008, the great financial crisis. And of course, here is the red line is the Fed funds rate. And they cut it. Again, prices were declining just before they cut it. But of course, as they cut rates, prices continued to decline along with the rate cuts due to that lag time again. Another major boom bust cycle in Japan. There's the cuts in, 1992 or so, 1991, 1992, and house prices declined. They could decline for a long time. I think it was like 15 years or so. But of course, they declined along with those cuts. And even when the rates hit rock bottom, prices still declined because they had such a big boom and bust over there. My homeland here, Ireland. Again, it was in that 2008. They called it Celtic Tiger leading up to this boom bust. And they started cutting. Prices were declining before the cuts because they had done their job. But of course, as they cut, they're not going to turn around right away. It takes time. So prices declined much further after those cuts stopped, actually. But yeah, they declined for, I don't know, what was it, 5, 6 years or so. So my point is when people tell you and professionals, whoever they are, say when they cut interest rates, the prices are going to take off, so you better buy now. It's all baloney. It's BS. The data doesn't support this. It makes sense that there's a lag time, just like there's a lag time when they raise interest rates. There's a lag time with cuts, and prices will drop with cuts. And of course, they're cutting rates to save the economy at that point because they've done their job. Here's one more chart. I'm going to go through this in detail here again. This is from the Canadian mortgage arrears from this Canadian Bankers Association and the Bank of Canada overnight rate, our main interest rate. And you can see the red line is the mortgage arrears. And of course, we're at rock bottom lows right now. But you can look at the inverse correlation there. Again, because of that lag time, when interest rates are low, mortgage arrears are high. And let me just bring up the next chart here because I've drawn it out with lines, and you can see a direct correlation. It's actually, it's insane. When mortgage arrears reach their peak, the rates are at their lowest in that cycle. So it's almost a perfect match. It actually is a perfect match. It's scary to say, but again, that lag time when they start to cut mortgage arrears, which is they're only 2 to 3 months ahead of defaults, so it's very representative of defaults, are at their peak when the rates finally hit their bottom. So now adding some context or some time frames to this chart, how long does it take from the time they first start cutting rates till mortgage arrears peak? And you can see back in 1990s, in the late 90s there, it was 22 months. Next in 2000, the dot-com bubble, that was 14 months. In 2008, it was 27 months. So it's safe to say anywhere from 12 to 24 months is how long it takes after they initially start cutting rates, which could be this year, could be the end of the year, it could be early next year. We actually don't know at this point. It keeps getting pushed back, these estimations or predictions of rate cuts from the Bank of Canada. So, of course, the gears were turning in my head, and I have sold a few bank sales in my career. Actually, my friends still live in these. These are actually good friends that I grew up with that had the opportunity to buy these bank sales for their primary residence. And they still live in them. So I looked back at my trades and my data, and I said, okay, these guys probably bought in 2010 or shortly after that 2008 cycle. All my data that I have, every one of them, there's 3 bank sales that I could remember, and I looked them up. I looked up the trades to see who was the seller on them. They all purchased in 2012. So here I've charted them on this mortgage arrears chart here also. So you can see there, times 3. That was when these 3 friends of mine bought their houses. So now I'm going to share the details of these, which is very interesting. The prices are very low. This was back in 2012, not that long ago, but again, very low prices. It's going to make you sick. But I want to put it into context to see when they bought them and when the previous owner bought them. And of course, they lost them to the bank in between that period somewhere. So here they are marked on the chart. This is when the previous owners that lost them to the banks purchased them. The first one there was bought in 1997. It was purchased for $90,000. They lost it to TD Bank. TD Bank couldn't recover their money. So, of course, it was handed off to the insurer, CMHC. And then my friends and clients bought it for $150,000 in 2012. The next one was purchased in 2002 by the previous owners. It was $73,500 that they paid. My guy bought it, or my good friend bought it in 2012 for $75,000. And it was with First Ontario Credit Union, the power of sale at the time. And the last one there on the timeline was purchased by the previous owner in 2005 for $225,000. My clients bought it in 2012 from the First National Bank or First National Financial, sorry, for $239,000. Was it a coincidence that I just happened to sell a bunch of bank sales to friends in 2012? Maybe, maybe not. There was good opportunities back then. There was obviously mortgage arrears peaked in 2010 to 2012. So it makes sense, in my opinion, that there was a good supply of these distressed sales on the market. Now, look at when these previous owners purchased them and when the bank was selling them. So the previous owners purchased them not when the interest rates were high. They purchased them when the interest rates were almost at their bottom in the cycle. And of course, when did the bank sell them? The bank sold them when the interest rates were low. So previous owners purchased them when the interest rates were low, went through the whole cycle of interest rates being high, and the bank sold them again when the interest rates had come back down. So it just goes to show you those interest rate hikes, they did their toll on these families or people that own these homes. And of course, it wasn't until years later that they actually finally lost them, because even 2, 3, 4, 5 years after these peak rate cycles, you're going to still be paying those peak rates, right? You can't just go and renew. You can't see rates come down and say, I'm just going to go get a new rate, because they're going to charge you a massive penalty. It's not the 3 months interest that most people think it is. There's an interest rate differential. So if rates come down from 5%, say, to 4%, and you say, well, I'm going to go refinance, the bank's going to charge you the rest of that interest for the remaining period, whether it's 3 years left in your 5-year term or whatever the case may be. They're charging you all that interest that you owe them, that you would have paid them, and then you can go get your 4%. So, of course, that's a great history lesson on what's happened. And the data, again, it doesn't lie. It's very accurate, and there's a very clear trend here. So now, where does that leave us in our current cycle? Well, we are so far into the rate hikes, or into the rate hold period, I should say. They're going to probably start cutting rates by mid to late year, depending on the economy and inflation. And of course, I predict buying opportunities to start later this year and into next year. It won't be peak mortgage arrears for another, 12 to 24 months after that, but buying opportunities will present themselves. Interest rates will be coming down. Now, you may be hesitant to buy at that point once the economy's weakened and people are losing jobs, but as long as you have a stable income and you haven't leveraged yourself elsewhere, it shouldn't be a problem, and you'll be able to take advantage of these distressed sales or people that are desperate that need to get out of these over leveraged properties. Okay, lastly, on to the statistics from the places that weren't included last week that didn't have the data ready. Still, there's a couple places that didn't have their data ready. I think New Brunswick was one of them. But anyway, let's go through them here. First, we have the month-over-month price changes from December last year to this January. Chilliwack and District down 8.5% month over month. Interior BC, Okanagan down 6.8%. Montreal down 2.7% month over month. Province of Quebec down 2.6%. Saskatchewan down just under a percent. Same with Newfoundland and Labrador down just under 1%. Ottawa, not much change. Nova Scotia, they are up 3.6% month over month. Next, moving on to the percent change from the peak. Chilliwack and District down 20% from the peak. Interior BC Okanagan down 17% from the peak. Ottawa down 16.5% from the peak. Saskatchewan down 10%. Nova Scotia down 8%. Province Quebec down 8%. Montreal down 6.3%. And Newfoundland and Labrador down 2.3%. Calgary is the only region or area in Canada that has made new highs this year. We'll see if there's any other places. I doubt it, but who knows? One of those outlying East Coast regions might make new peaks, because I know Newfoundland and Labrador is not far off right now. Dollar changes from the peak in these regions. 184 grand Chilliwack and District, they're down. Okanagan, 127 grand. Ottawa down 126. Province of Quebec down just under 40. Montreal just under 40. Nova Scotia down 37,000. Saskatchewan down 32,000. And Newfoundland and Labrador down 7,000 from the peak. And lastly, looking at the market balance, the sales to new listings ratio, buyers markets in Interior BC, Okanagan, and Montreal, and the rest are all in balanced markets. So that's it for this week. Thanks for watching, and I'll see you next Tuesday.